Welcome to everyone joining us this afternoon. We've had a great turnout for what we hope will be a lively discussion. For anyone that I have not met, I'm Eileen O'Connor, co-founder and CEO of Hemington Wealth Management, and I'm delighted to welcome Dr. Apollo Lupescu to our conversation this afternoon. Apollo is vice president at Dimensional Fund Advisors, which, as many of you know, is one of the premier investment managers in the world, managing more than 500 billion in client assets. Apollo earned his PhD in economics and finance at UC Santa Barbara and has, over the past 16 years at Dimensional, become an internationally recognized speaker who's delivered hundreds of lectures and seminars to both financial professionals as well as individual investors because he excels at explaining investment concepts in a clear and understandable way. I personally have worked with Apollo for many years, and since he's addressing questions from clients across the globe, including me, I thought it would be a great opportunity for Hemington clients to hear from him directly.
I'll start with the name of the event here, the upcoming election. So it seems that the country is more polarized than ever. We have had the most questions and concern raised by our clients about the current state of the union that I personally can ever recall in my history of being a financial advisor. And of course, this is understandable given the stark differences between the different proposals, especially as it relates to taxes, not only income, but capital gains and estate tax system as well, just to name a few stark contrasts between the parties. What are the implications of a Republican or Democratic administration? And as investors, how can we be best prepared no matter what the outcome?
Right. Well, first of all, thank you so much for having us. And I do recognize the background. I think we had an event a few years ago, and I can't wait to kind of go back there. So thank you for the invitation to be here, and thanks to all of you on the online for attending. And it is a big question. And perhaps before I get going and try to dive into this, one quick logistics. If you use a Windows computer, on the right-hand side of the Zoom window, there are three icons. There's an X, there's a square, and a line. And if you click on the square, that would maximize the window and put the video over the entire screen. And that would help with seeing maybe some numbers later on. And if you have a Mac, it's on the left-hand side. I think there's a green dot with a plus sign. And once again, that turns the video over to the entire screen. So that, from a viewing perspective, not that you need to see me in great detail, but later on, that might come in handy. So let's talk about the election, because as you said, I think it's a great way to start. And particularly the word that he used, polarized, is a really good one, because that's what it feels like. And we're not really listening to each other, and we're listening more to reply than to understand what the other side is saying. And it feels different. And to begin with, I would say that in general, politics, it touches on our deeply held beliefs and our identity as individuals and core values. And because of that, it is a very, very emotional subject. And there's nothing wrong with feeling emotions around politics and this election cycle, and nothing at all. I think that the issue is that when it comes to making decisions about money, are these emotions always leading us to great decisions? And frankly speaking, in my life, not even talking about investing in general, whenever I was clouded with emotion, I'm not sure decisions are made were always in my best interest. And particularly when it comes to investing, there's quite a lot of evidence that emotions don't play a really positive role in outcomes for investors. So what I'm suggesting is this: I would love to acknowledge these emotions and validate and make sure it's absolutely okay and understandable why you're having them. Our job and Eileen's job is to pay attention to them and at the same time disentangle these emotions from investment decisions. And whatever I'll be talking about is not trying to make you feel good or bad about your political views, but rather when we look pragmatically at the election from a numbers perspective, when we analyze the data and the evidence, the question is, what do we see there? What are some of the lessons that would help all of us as investors? So the perspective that I'll give is not, again, partisan in any way. I'm not going to tell that one is better than the other in any way, policy wise, whatever. What I'm going to suggest is let's look at the numbers and see what is the story that the numbers are telling us. And I'll start with taking a step back is that in these uncertain times, people are asking, well, does an election to begin with actually involve more uncertainty, and shouldn't this additional uncertainty make the markets behave differently than otherwise would? Because there's that wisdom out there, don't know where it came from, but the markets don't like uncertainty. And whenever uncertainty pops around, that's not good for the market. So to begin with, let's look at elections at the market. And elections have been around since 1776 or so, since we became a country, but stock market data only goes back to 1926. So we have 94 years of good data. And the stock market here will be represented by something called the S&P 500, Standard & Poor's 500, which is a collection of the largest companies in the U.S. stock market. So when we go back to 1926, over these 94 years, what we see is that we have 23 different presidential elections. So that's a pretty good place to start. What are we seeing historically when it comes to election years? How different are they? And is it a good thing or a bad thing for the market to be in an election year? The place to start is just look at an average. When we have these 23 different data points, when we have these election years, what do we see the market doing on average? And on average, does it go up or does it go down? When we ran the analysis, what we found is that on average in these 23 different election years, the market actually went up by an average of about 11.3%. So election years by themselves, it doesn't mean that it's doom and gloom and it's a terrible thing for the market. On the contrary, the market does go up quite nicely on average in an election year. And one more thing, this average is not vastly different than non-election years. So again, it doesn't seem that being in an election year is vastly different than being in a non-election year. But average quite often means that the market goes up, or it could actually go down. And I'm going to ask you, I know I wish I was in the room to ask you, but put a number in your head. Out of the 23 elections, how many do you think that the market went up, had a positive return that year versus a negative one? And we ran that analysis, and what we found is that out of the 23 different elections, 19 out of the 23, the market had positive results, meaning it went up in an election year, but there are 4 years when it went down. What's interesting is that the majority of the time, the preponderance, the market tends to go up in an election year, but not every time. And once again, when you look at the difference between election and non-election years, this split between positive and negative years, it's a little bit better than non-election years, but not by much. Once again, it's an indication that being an election year is not necessarily doom and gloom for investors. And what I thought might be interesting is to perhaps take a closer look at these 4 instances when the market did go down, and see if there are any lessons from which we can learn to help us cope with the current situation. And what I found is indeed there's an amazingly useful lesson that we can learn from this. So let's look at these 4 instances one by one. The first one is 1932. And in 1932, we had FDR versus Hoover. The market went down by about 8%. But there was also the worst year of the Great Depression. So we did have an election, but we also had the Great Depression. 8 years later, in 1940, once again, a negative market return in an election. But that was the year when Germany invaded Europe, and it became obvious this would become a world war. And it took 60 years during which we had, discord in the country. We had civil movement. We had a presidential candidate shot and killed. And yet it wasn't until 2000 when once again we saw it. And that was Bush versus Gore. And I do have to say that if you look at Bush versus Gore, that was a contested election. We did not know the winner the night of the election. It took some time. It went all the way to the Supreme Court. But eventually, as a country, we sorted it out and we moved on. Now, is there something there that because it was a contested election, that would necessarily mean that the market's not reacting very well to that? Well, it turns out that by the time election came around, by the end of October, the market had already dropped. And why is that? Because of pets.com and a lot of these high-flying tech stocks that were going down in value. So yes, we did have that election, but we also had the beginning of the dot-com bust. And then the last one, obviously, in 08, had to do with the financial crisis. So as an observation, what became really apparent to me is that in every single year, in every single case when the market dropped in an election year, there was something a lot bigger going on in the world rather than just the election itself. And it's a really important thing because it's going to lead to one of the primary conclusions that I'm going to put forth, which is that elections and politics are a variable when it comes to the stock market, but not the variable. It is not the main driver of what the market does. As much as the media would like to make that causality, it is not the case. There are a lot bigger things happening that might drive the market rather than who is in the White House. And frankly, nobody can quantify this, but if you ask me, I would say that how much do politics and elections matter? 5, maybe 10% of what might drive the market comes from the elections and politics, but it's a relatively minor variable in the big scheme of things. Look at every single instance when the market dropped and also when the market went up. Was it driven by the election of president or not? And one more note here, I think it's important. What I'm present here is a whole year. And the reason I want to bring this up is because around election day, it is quite possible that there will be fluctuations in the market. Remember 2016, the night when the election was called, the market tanked. It dropped significantly that night, and yet by the end of the first day, it moved up higher. So there's a lot of bounciness around election day, and if that happens again, I wouldn't be surprised. And it's possible that we might see this time around. It's a little bit like if you have a rock and you throw it into a lake or a pond, at the point of impact, the ripples could be quite big. So that's the election day, and maybe days or weeks before that, you're going to see on either side of the election, maybe some movements in the market. It wouldn't be unusual. We've seen that in the past. But the further you move out away from that election day, the more these smooth out to the point where they become insignificant. They become like election. Well, that was old news. And that's kind of what we see in the past. And the reason I bring this up is because stock market investing shouldn't be about a week or a month. It should be much more considered in years. And that's what I'm showing you, years, rather than what happens on a weekly or a daily basis around the election. So again, in that respect, it does seem that this is not the primary variable, that other bigger things might drive what happens in the market. Now, to the question that you asked, Eileen, what about presidents? How much do presidents matter? Does it matter if we have President Biden or the current administration? And when we looked at this, instead of going back to 1926, just to make it easier, I went into my lifetime, and I'm born in 1969. And when I was born, President Nixon was in office. And for the 5 years or so that he was in office, on average, the market actually dropped about 3% during his tenure. And then President Ford came along, and on average, during the couple of years that he was in office, roughly, the market went up about 20%. And if you fast forward and you look at the different presidents and the average annualized returns per year during their time in office, the first thing that became very apparent to me is there's no discernible pattern to tell you that having a Republican or a Democrat is better or worse for the market. I just don't see it. It just doesn't seem obvious at all to me to see that pattern. And in fact, I would take it a step further and say that a president should receive neither credit nor blame for what happens in the market during their tenure. Why? Take President Nixon. We talked about him, negative 3% on average per year. Before he set foot in the office, there was a move to change from the gold standard to the type of currency that we have today. And, there was some, initially as we changed, there was a big change, and there were some situations that arose. In the early 70s, because of a crisis in the Middle East, OPEC imposed an oil embargo against the U.S., which led to should President Nixon be blamed for that because the market didn't do well? I don't think so. It's not fair. The same with George W. Bush. just as just as you walked in the White House, the .com started to unfold, something he had nothing to do with, and it was on for years afterwards. 9/11 happened 9 months into his term, and he walked off at the bottom of the financial crisis. Should he receive blame for that? Absolutely not. The same way that President Clinton, he happened to be in office when these big tech companies got formed. That just happened. That's when they got established. The Googles and the Yahoos and the Microsoft, not the Microsoft, but the Googles and the all these giant tech firms that we know today. And it just happened to be there. The Amazons, and he had good returns during his tenure. Should he receive credit? Again, this is not about a public Republicans or Democrats. It's just simply looking and saying there are a lot bigger things driving the market than who is in the White House. And for that reason, I don't believe that a president should receive credit or blame, because there are so many other things that might impact the returns during their time in office. Now, there's the other question that he kind of touched on. What about taxes? Because I think a lot of investors are looking and saying, well, of course, tax policy has to matter, and how much is an impact? How much does that impact the market? Having a president with a business-friendly attitude and also tax cuts will certainly seems to benefit the market, whereas other presidents that might raise taxes, that can be that good for the market. And once again, we can look at the evidence. When you look at the numbers, President Reagan, really well known for tax cuts, particularly income, big slash to the income tax rates, and really market did very well. $1 invested at the beginning of his presidency, by the time he left, would have more than tripled to $3.24. Which is great. You triple your money in 8 years. The market did really well during those times of tax cuts. We also had President George W. Bush, and he had 2 rounds of tax cuts, some specifically targeting investments like long-term gains and dividends. And he had $1 invested at the beginning of his presidency would have turned to 70 cents 8 years later. So tax policy does not guarantee, and tax cuts do not guarantee good returns in the market. President Clinton, in fact, had higher taxes, but it seems that the market also did higher than either of these tax cut presidents. So to me, I would be cautious about making a judgment that these might be good or bad. Individuals and companies have had to deal with higher taxes for many years. What did companies do up until a few years ago? You create a subsidiary in some other country with a lower tax rate, and you do some asset transfer pricing, and then you find a way to mitigate taxes. They've done it. Eileen has done this, and Hemington has done this for a long time. And if taxes do change, and we have no idea how they'll change, but if they do change, whether it's estate planning taxes and all that, first of all, they might or might not impact the market. But secondly, they know how to deal with this. They've dealt with this for many years, and they're perfectly legal ways to either use more tax efficient investments or to create something called loss harvesting or asset location, their trust. I mean, there's so many things that you can ask your advisor. If taxes do change, it reinforces their value more than anything else. And I also want to be cautious, because when people are also saying, well, but ultimately this is not going to be good for the market if we don't have these business-friendly presidents, it's not necessarily doom and gloom. If you look at 12 years ago, as I was on the road, not just in Virginia, but pretty much across the country, particularly in some parts of the country, where they're not really excited about the prospect of perhaps President Obama coming into office at the time, was still a candidate. They're really concerned and saying, this looks to me like a socialist type of government. They cannot be good for the markets, and I need to pull my money out. And I heard this over and over and over again. And what's interesting is that if you look at President Obama, really known for helping millions with healthcare and Obamacare, what happened to the market during his term? 2 terms. What happened was that $1 invested at the beginning of his presidency would have more than tripled by the end when he left 8 years later. And you know what's remarkable? It is similar, in fact, eerily similar to what happened during the Reagan years. So whether you had somebody who is really well known for Obamacare or somebody well known for the tax cuts and of the Reagan years, the market pretty much responded identically. And that's what I'm really cautioning people not to go out there and say, well, I need to make a move of my money either because I'm excited or not excited about the prospects of what might happen with one president or another. It will not matter for your money, whether it's President Biden or President Trump. A lot bigger things will drive, and I'll tell you in a second why. But before we go to that, I do want to touch on one other thing that I find is important, Eileen, and that is that White House is important, but all these spending laws and tax laws do have to be passed by Congress, the legislative branch. So what do we see when it comes to Congress? Going back to the 1920s and looking at the market and how it did during Republicans and Democrats, the only trend that is apparent is that the market tends to go up irrespective of who's in control of Congress. Democrats were in control of Congress for many, many years, and the markets went up quite nicely. And so were Republicans, and the markets went up. But in neither case does it appear that the market had a smoother ride on the Republicans or Democrats. There was a 73, 74 bump right here, and there was a dot-com bust with the Republicans. So in either case, it doesn't seem that it's a perfectly smooth ride, but it is the market is rewarding long-term investors. And to me, the one statistic it's so important is looking at something that is called unified government. And the reason I think it's important is because right now there is perhaps a thinking among some people, what if the news and what you hear about the blue wave coming in and sweeping Congress, what would be the impact to my money of that situation if it does actually pan out the way that it's kind of put out there in the media? And let's look at this idea of a unified government. And what it means is that Senate, the House, the Senate, the House, and the White House all belong to the same party. That's the word that I would use, unified, not because everybody kind of plays along and it's kumbaya time. No, but it's just unified, meaning that the party controls the House, the Senate, and the White House. And if you look at the Republicans, they have had this unified government for 13 years over this time frame. And if you look at the Democrats, they have actually had it for 37 years, so a lot longer Democratic control of these three at the same time than Republicans. And when we ran the numbers, what we find is that during these 13 years of unified Republican control, the market on average returned 14.52% to investors. So it's a really nice growth. The question is, what did we see when it came to the Democrats during these unified Democratic times? Well, the average was 14.52. Identical to the second decimal. And it's not an error. We kind of went over this twice and several times, actually. It is identical to the second decimal. Just to show you how little does it matter if you have a Republican or a Democrat unified government. It's just basically it's not the primary driver of the market. So it's really important to note this. Now the question is why? Why do we see this, and what's the underlying reason that we're suggesting that this doesn't matter? And to me, the primary reason is because us as individuals, we don't change our behavior as a government changes, a president changes. 2 weeks from now, half the country will feel very optimistic about the future, what it's the market, it's the economy, and half will be pessimistic. If you're on the losing end, you're not going to feel great about where the country is going, the market and the economy. Roughly half will. But everybody, whether you're feeling pessimistic or optimistic, what we see is that they are resilient and they will continue to do the things that they did before. It doesn't matter who's in office. Will you eat fewer blueberries? Will you buy fewer boxes of Cheerios and go to the bowling alley more or less often? You're going to carry on what you do. And that's why it's so important that we don't change our behavior as consumers in response to that. You know, we might not like policies, but the day-to-day things that we do, they're not going to vary very much. And companies will continue to seek opportunities and continue to seek profit opportunities in whatever state of the world we're in. They're going to look for that. And as I said, profits, if you think of Apple, what do you think matters more? The products they have, the services, competition, the strategy, how they execute it, what's going on in the world, or who's in the White House? What's the primary driver of profits, which really determine the value of a stock? I would, again, say that it's something that it's under their own control. So people are resilient, and that makes companies resilient. And because companies are resilient, so will the market. And to me, that's the fundamental thing. Irrespective of whether Donald Trump or Joe Biden is president in January, that fundamental premise of free markets and capitalism will not change. Companies will seek opportunity under whatever circumstances, and their profits are more likely to be impacted by things that are either under their control or much bigger things happening in the world rather than the policies in Washington. So I've been talking for quite a while, Eileen, and I want to make sure that it doesn't become a monologue, although it has been a monologue so far.
So appreciated, and I love exploring whether there's a connection between current events and investment returns, because you can talk about the election or many other topics, and the story is kind of the same. So I really appreciate that. And for our Hemington clients, we talk a lot about having a non-forecasting investment philosophy, right? I think some of those slides really point to how difficult it is to be able to forecast into the future and win, right? It's not always as intuitive as it might seem. And then the second comment I'd say is, thank you for mentioning, but when there are large changes, right, it's our job to uncover the financial planning opportunities, right? And that's what we spend most of our days doing. So thanks so much for that. From all of us at Hemington, we certainly hope that you and your family stay healthy and content through the next couple weeks and beyond. So thanks so much, and good night.